Good evening, ladies and gentlemen. It gives me great pleasure to be with the future leaders of Africa tonight, as well as very committed stakeholders to the opportunity that Africa represents. I'm particularly grateful to the organizers for inviting me to share insights from my experience and journey of working in Africa. And they've gone a little bit further, and they've given me the liberty to actually select a topic that I feel will be quite appropriate for this audience. One of the things I'm always very concerned about is that in the course of a dinner speech after a long day, a long speech would typically put people to sleep. If you must sleep, please do not snore loudly. In terms of the direction and topic which I felt was most appropriate tonight, and I do again appreciate the liberty I've been given, is Africa's growth and future, enabling the financial market catalyst for development in Africa. And I shared some of this with Shehu yesterday evening. He had some comments, and I'm very grateful for some of the insights he's given, as well as some of our colleagues here, Antonia and a couple of our other colleagues who very much would have wanted to be here from London, but we're very conscious about cost at this time of the year, so they've only volunteered about 5-6 of us to come. That's so today we're going to look at a quick overview of the current situation in terms of how we see the financial markets and access to capital as a catalyst for development in Africa. We're going to look at the solutions and the enablers which we see from our journey and for our interaction with key stakeholders, with businesses, with entrepreneurs, with sovereigns, and with funds and investors coming into Africa. And hopefully, at the end of the paper, I will probably be able to do some level of questions and answers. So if that's okay, I'll just get started. Africa's growth potential continues to set it apart from other emerging markets. I'm sure that all through the presentations today, you've been given lots of data regarding this, so I'm not going to be able to do as much justice to that as the excellent presentations we got from our friends from BCG, from the panel that spoke about the carriers in Africa, and which gave a very good reflection of the fact that it is not always as much of a rosy story as people say, but that good fortune does come to those who are well prepared. This growth has been greatly impacted by the slowdown in some key trading partners. But the point that we need to also appreciate the fact that Africa is not an island. It's very well integrated into the capital flows and investment flows. But the good thing is that post the financial crisis, the investors are a lot more aware of the opportunities that Africa represents, because in the olden days when we did financing and we had to look at Greece, Italy, and a number of markets, irrespective of the fact, the deep awareness that we have of the macroeconomics of some of these markets, they will always be rated far superior to the risk in Africa. But the current situation has actually given people the clear understanding that it is not just at the macro level on account of your postcode, or if it's in the US, I think it's the zip code that does matter in terms of success or failure, and that financial mismanagement does not have a residence in Africa. The current period of high growth in Africa, I would say, is probably the longest and the most sustained in decades, and has been predicated on a number of factors. And in quick summary, what I would say is that in terms of what we've seen, it's very much driven by commodity prices, natural resources. You probably will have known about this in terms of the very exciting finds for oil and gas resources in Ghana, Mozambique, Uganda, Tanzania. The long-running political stability in terms of governance with several stable, though quite imperfect democracies. We've seen a trend where across the board, infrastructure has improved, as well as we've seen a very sustained growth in domestic consumer demand from the emerging middle classes. But what has changed this in the historical equation? Because commodities in terms of natural resources, whether it's oil and gas, whether it's mining resources, whether it's agricultural resources, they were always there in Africa anyway. And I would also like to state as well that we always had people who had quite a lot of latent demand for some of these resources and some of the things that are being produced. I would like to propose that while resources have been there and the demand has always been there, the key thing that has changed is the fact that there is a lot more access to financial markets as well as to capital, which in my view has been the catalyst that has actually allowed these trends and these themes to actually combine in a way that they can create value. And that is what gives a whole lot of opportunity that we see and that sustained the growth over the last few years. To sustain this growth, however, we need to understand how to enable financial markets as a catalyst for development of infrastructure and the stimulation of domestic consumer demand. This is a worthy role for MBAs with keen interest in working or investing in Africa, as well as people that have had experience in working in more developed markets and or that have seen trends as they have gathered pace in other markets. So, despite a sometimes halting pace to market liberalization, as countries experience balance of payment difficulties, flows into the regions continue to scale up significantly, driven primarily by the attractive high yields offered by the sub-Saharan African markets and the deepening of African capital markets, which has reflected the growing financing requirements of Africa's sovereign and non-sovereign entities. It continues apace in terms of the issuance of debt securities, the participation of private equity and other investors in the markets. Ladies and gentlemen, this awareness should make you very excited. I'm proud of the quality of talent we have here present in this hall who are keen to engage with Africa, where they will bring the knowledge and talent that they have gained in Wharton and other great institutions to bear on the challenges and opportunities that exist in Africa. Well, I do expect the Wharton grads or the Wharton students to clap for themselves. Now, to continue on this same pace, my paper is not going to focus on domestic demand stimulation or supply side or demand side economics, which is visible and continues to gather momentum irrespective of what we do in Africa. And what has really made that more real? It is banking reforms. It's establishment of credit bureaus. It is client due diligence, KYC, anti-money laundering, and improved access to finance for mortgages, and more importantly, SMEs for entrepreneurs across Africa. And this is so important. The value chain of these are all very exciting areas where you can invest as an entrepreneur or as a manufacturer of those services. And one of the things I was quite pleased to hear during the careers session was the challenge that was thrown to a lot of us here is that it is not about trying to aspire towards a soft landing in going back into Africa or engaging with Africa, but being bold and courageous and having a mix of both trying to work with established corporates like Standard Chartered or actually going out and seeking an opportunity, because in every one of the markets that is growing in Africa. There is a need to establish credit bureaus. There's a need to establish mortgage finance houses. There's a need to profile and issue credit cards. I mean, I get extremely excited when I use the credit cards that I issued in Nigeria when I'm shopping in the UK or anywhere. I get a credit alert almost instantly before I leave the POS terminal. That does not happen. In the UK, we do batch system. 2-3 days later, it will be debited or credited to your account. But the situation in Africa has meant that the investment in terms of technology, Africa has been able to leapfrog significantly quite a number of the basic consumer and the copper wire type models for distributing data or financial services. And a lot of people are probably not aware that, for those of us that live in the UK, that the mobile banking that is being rolled out by Barclays, NatWest, and a number of institutions now was actually pioneered and developed in Kenya through the M-Pesa system. So these are things that you should all be very, very proud of. And things have moved from a situation whereby Africa takes information skills and talent from other places, but Africa is actually giving back a lot. What I would challenge everybody here present today is to think about taking back some of the skills that you've gained and taking back some of the experiences that you've earned and the training and the exposure to be able to look at opportunities from a completely different frame of lens. I did say at the BCG session that it's really important to use, for those of us that are visually challenged, bifocals are good. And you should remove them sometimes when you can't see the script. So if I make any mistakes while I'm talking, I'm just going to blame my optician. So we will instead be focusing quite a bit on the infrastructure, which we do believe is a backbone for economic development. We believe that infrastructure has a huge deficit in Africa. And we believe that, and from research and from available experience to us, that while 7 out of the fastest growing economies are in Africa, and when you see the 7% club and all that, that approximately 30% of the world's mineral resources are available in Africa. Yet, over 600 million Africans live without any form of regular electricity. And this is something that, and I focus on electricity not just because Antonia spends a huge amount of time trying to develop power system in challenging markets, but because it's an absolute catalyst in terms of competitiveness and in terms of attracting and creating a good quality of life for the middle class, as well as creating demand for goods, as well as ensuring that the industries and the manufacturing we have in Africa is competitive and comparable to what we have in other countries of the world. So, what do we mean by infrastructure? Telecoms, everybody's pretty covered, pretty familiar with that, and you're very familiar with the fact that the telecoms boom in Africa has led to the rebasing of GDP. The markets have changed in terms of dynamism, and commerce and waste is minimized. Transportation works reasonably okay, but I must emphasize that transportation and port systems are very much geared to what our friends in BCG did refer to earlier today as trading outposts, to be able to exploit and export resources, and are not geared towards any form of meaningful interregional integration. At the other end of the spectrum, water and sewage, which is generally considered as the ultimate public good. Most people do like to use it, and most people in Africa do not tend to always pay for it. Therefore, it makes it really bankable or not bankable. And obviously, when you look at power, there are historical reasons why it hasn't happened. But again, why it hasn't happened does not stop us from spending a lot more time on it, because it does have a huge multiplier effect in terms of the development you see in most countries in the world. Good example is probably continental Europe and the UK, and in terms of France or Germany. the competitiveness of manufacturing you see in continental Europe compared to the UK. Of course, we do have our challenges in terms of being dependent on the city and the ability to tax the city, and the fact that we do not like to manufacture anything and like to import cheap stuff and get them fabricated from IKEA. But those are all by the way. But the reality is the fact that competitively, it's a lot more expensive to make things in markets where power is very expensive. And that has been a big challenge in terms of being able to do business in Africa. Now, when you look at lack of infrastructure investment, it hampers several things, whether it's planning, people development, looking at PPP frameworks. You need to be able to look at policy to balance investor returns and consumer welfare. You need to look at emerging market risk, instability, asymmetry of information, which is something that a lot of people spend a lot of time considering when they are taking decisions. You look at the fact that there are over $5 trillion in terms of $5 trillion in value of sovereign wealth funds, and maybe only about 1 to 2% is available, is being invested or being made available to Africa. But then, when you look at some of those things, you also see some of the transactions and opportunities that we have been involved, where you actually see significant good news, and which borders on resource, which borders on infrastructure, which borders on, and you see the catalytic effect that this has on country development. The good news, of course, is that among financial institutions, there's appetite for long-term infrastructure financing, up to a point until Basel III came along. The majority of development financing and infrastructure financing and oil and gas and resource financing that we see today is actually coming from private sources, and less so from the traditional public sources. And there are several examples of this. We had the privilege of leading the Jubilee financing in Ghana, and ABS Soka, one of the leaders of the bank, he was the CEO, and I flew in from London then, and we had to triangulate a lot of stakeholders to get it off the ground. But fast forward 5 years later, you go to Ghana. First, the bad news. All the house prices around the posh areas have all gone up. But to drive to those posh houses, you now have, genuine road infrastructure that is working. You've seen development in terms of the oil and gas taxes being deployed. I mean, an economy that was essentially what you call, for those of you that are familiar with macro statistics, was declared a HIPIC country. HIPIC means highly indebted, poor country. Suddenly now issues a bond in the market and is 10 times oversubscribed. So you could actually feel the buzz. So the kind of work we've done with investors like Cosmos Energy, Warburg Pincus, Tolo, Anadarko, a number of players, has transformed the country. So you could actually, and this is when people ask me about my personal journey in the bank, say, why is it that you do what you do and what keeps you in the bank? Is the ability to actually start something that was nothing, work with it, close the transaction. It may cost $1 billion, $2 billion. Get some banks who do not have, or financial institutions who do not have the kind of appetite that Standard Chartered Bank has into those markets, make the deals work, get the infrastructure or the project to work, generate cash flows to repay the financiers and, of course, our fees, and move on from there, taxes for the government, the middle class expands, and you go there, and the guys you were negotiating with 5 years ago, who were directors in ministries, guess what? They are now the CEOs of the National Oil Corporation. And it also helps when you see some of them made ministers because of policy decisions which you help them to take based on the experience you have had in other markets. There is no, when you wake up every day and you go to work and you have the opportunity to do what you do best, that is truly transformational, and it connects you with the true development of Africa as it is. And you're right at the cutting edge of transformation, of getting environments and putting in place structures and policies and processes that actually helps a number of these countries to develop. Similar experience we've had in Ghana is what we've done with Angola. Over the last 10 years, we've raised, I would say, probably an aggregate of about $30 billion through our partners, our friends in the financial markets to develop oil and gas in Angola. Today, Angola is only second to Nigeria in terms of oil and gas development. Similarly, over the last 5 to 10 years, almost every significant oil and gas project in Africa, we've led those transactions. So out of 10, we'll probably do 7, and hopefully the other banks will have to compete for the 3. And this is the kind of shape that we do hope will be sustained when we have a lot more Wharton graduates join the team and help us to close deals. Gabon is a country where you have significant amount of gas, and there's a huge amount of opportunity to develop agriculture. The gas gets flared. There's an opportunity to work with Holland, one of the leading companies that incidentally actually started off in Nigeria, to develop a gas to fertilizer project. Take further Dangote in Nigeria. I'm sure you're all aware of the $9 billion project financing that we're looking to finalize over the next few days. We've closed the deal, but funding is yet to be called on a fertilizer and refinery and petrochemical complex, which is going to cost $9 billion. Pure private sector investment into the market. This will be transformational. Cement across Africa, Senegal, South Africa, different places, you're seeing development going on. But what does this mean for you? The more investment happens, the more opportunities exist for you to go into those businesses, be part of the supply chain of those businesses, be employed by those businesses, and to actually contribute your PIB to the development of Africa, and or gain from the pace of development. Because you might even choose that you're just a yield taker and you're not going to contribute. For Africa provides a very wide landscape and a wide canvas for all sorts of people with different appetites. So, when you look at what has been going on, how has these funds been mobilized? I would say that the yield for most products in Africa is a lot better than what you see in most markets. And I was sharing with Stefano earlier on that when an international company does invest in Africa, on a base level, the returns are as much as twice what it will get in its own market. And you'll probably get fired at some stage if you achieve the yield that you get in Europe. So what does that mean? It means that there's so much in terms of yield, in terms of opportunity. Of course, you've got to be very careful in managing your risk. And managing your risk does carry a whole lot of expertise, and part of that and knowledge is by investing in hiring the right set of individuals and talent from who are well-trained and who've got the global exposure, yet the local understanding to marry both skills together to actually deliver value for those businesses. In terms of liquidity, people tend to look at the kind of external liquidity that is being generated. But one story that is not being fully appreciated is the development of the local banks in and around Africa. The financial system and the financial architecture in Africa has actually grown significantly. And I would say that in most of the markets where we operate, whether it's Ghana, Nigeria, Cameroon, Cote d'Ivoire, we do make it a discipline to ensure that local banks actually do participate and are engaged in the financings we do. Now, there's a bit of wisdom in that, and I'll share that with you today. Typically, people go and take country risk insurance. And I'm one of those people who do project finance, and I've done over a 10-year period. We've not lost any money on account of country risk and stuff like that. So, one very thing you should take away from this evening is that the easiest way and the most efficient country risk insurance you can actually have for a financing in Africa is to get a lot of foreign banks involved in the financing. Guess what? No sensible government is going to nationalize a project that has been financed by banks where it has mom and pops and pension funds as shareholders. So you're wasting your time by paying a lot of fees. For those of you that are inclined to participate in the insurance and credit guarantee business, just get a lot of African banks to co-lend with you and work with you on projects, and no government, no minister of finance, no regulatory authority would ever nationalize it. And by the way, if they start, just send the delegation of banks led by the CEOs of those local banks to go to the parliament or the presidency and cry a lot. It will stop. These are stories from my journey, and believe me, it has actually, I've had to put this into practice. In Ghana, in a number of countries that would remain that want us to be quite discreet about. Now, you see a number of Eurobond issuances across Africa. But guess what we're seeing in terms of galvanizing financing and financing terms? Zambia came to the market with $750 million on offer. Guess what? It was 15 times oversubscribed. I hope you understand what I said. There is very few bonds that has ever been issued on a sovereign level anywhere in the developed market that has been 15 times oversubscribed. That means the country wanted $750 million, and it got commitments for, you can do the numbers, close to over $10 billion. Nigeria, the same trend. Ghana, the same trend. Senegal, we led the bond in Senegal. When Angola did the bond as well, also oversubscribed. So you have a wall of cash, a wall of appetite, and a keen awareness of the fact that Africa is not just an opportunity for today, but the market to invest on for the long term. Because guess what these bonds help to do? They help us to establish benchmarks to be able to benchmark infrastructure projects and to be able to lengthen the yield curve in a number of this market. So when you look at indexes and African markets getting included in the indexes, what does it do automatically? You create a huge level of new liquidity looking at Africa. So when Nigeria got included, South Africa got included, it improved the awareness in the JP Morgan fund. It had nothing to do with our friends in JP Morgan here. It has a lot to do with the sovereign ratings and a lot of hard work that was put in to prepare a number of these countries to be able to report. Because the fundamentals for quite a number of these companies, of these sovereigns, are actually every bit as good, if not better, than a number of European markets. But they do fail woefully to tell their story in a meaningful manner. And all of you guys here, as you get engaged in private policy, you must also take an interest in public policy. Because one thing my old professor taught me in Cass Business School, a much less prestigious institution to yours, is the fact that forget all the story. It's the macro that actually matters. But guess what? It's not just the macro. It is how the macro is reported. So always read the tea leaves, but ensure that it is being reported by people that understand what it means. So when you look at that, it gives a whole lot of, so you understand where the funding is coming from. However, the bad news is that there's still a lot of challenges. Liberalization has not necessarily been flavor of the moment in all the markets. African markets have not embraced unfettered liberalization. Currency depreciation often poses outsized inflation and therefore political risk to a number of investors. Regulators in Africa have not shied away from throwing sand in the wheels of international market flows when conditions have warranted a protective stance. So typically you'll find capital flows being restricted to 1 month, and then tomorrow it's probably going to be 1 year. It's almost like a very familiar script you see from Latin America, which is altogether a different kettle of fish. And I'm sure you're probably aware, for those that do go to Argentina and a number of those markets, that other than the high-quality Malbec that is produced in large quantities, defaults are also quite common. I do like the Malbec. Yes. The overall environment in Africa remains more liberal than in many other markets, but we must not shy away from the fact that there's still a lot of bad behavior from our regulators, from the investors, and from oligarchs and oligopolists who typically take advantage of some of the, resource imbalances to extract disproportionate amount of value. But I do love capitalism, but one has to have a huge balance. And when it comes to the awareness, and one of the awareness of some of these things, by the time you've got talent of your caliber working in a number of these companies, you have the huge opportunity to be able to provide context and infect them with your values. The values, I mean, about doing business the right way, and the fact that it's actually much more sustainable to have yields of about 30% and not 50 or 100%. That's what I would say. In most markets, you consider an IRR of 30, 40% fairly quite rich, but in Africa, I think it's fairly commonplace. If you did that in most markets, you trigger an antitrust investigation, I'm sure. So the other challenge, of course, is, I did hear that used very frequently today, and I'm happy that everybody is very clear about that Africa is not a country. There are a number of subscale markets, inter-regional trade and financial links. While they have grown reasonably rapidly, regional communities are still a long way from achieving integration among countries, or with each other for that matter. There is sometimes a whole lot of competition, which doesn't make any sense. Economic as well as political balkanization of Africa seems to remain in the mindset, which if you look at the transportation linkages, that remain more reflective of colonial trading outposts, export orientation, rather than actually facilitating trade and commerce within countries or among countries and being able to deliver value. So, when we look at the macroeconomic challenges, the governance and management challenges, it has become extremely clear that public sector is not equipped to build, own, operate, and manage infrastructure or similar assets. Inadequate local expertise to structure sustainable long-term financing on a large scale for these projects have also created a hindrance. Political interference in terms of appointments of inappropriate concession holders, unsuitable project location, which is usually much more aligned with the location of the village of the head of state of particular countries other than sensible management decisions, just gives you the view that public sector is a very problematic stakeholder. And then even when you have this being done, you discover that the domestic concession holders may not necessarily have the right management experience for the difficult initial stages of the project, which brings both a risk and as well as an opportunity. First, for our friend in BCG, McKinsey, and a number of other institutions, it provides you the opportunity to advise them on how to structure these projects. For the talent available in this room, the young professionals here, it gives you an opportunity to work with them to set it right. But even more importantly, your experience of developing partnerships, building networks, gives you the feeling, and very quickly, that if you have a cement factory or a clinker deposit somewhere in Senegal, it probably makes sense to get world-class investors working with you on the JV to develop it, because typically if you have 10% of, say, 50% of a billion is a lot better than 100% of 100 million. So partnerships are very important. And one of the things that is very important as well is to also realize the fact that you may well have to be carried on account of the fact that you may not be able to access financial markets on your own basis. Because even when the projects look bankable, if you do not have strong enough parties who can put the deals with the right economics, strong construction framework or concession framework, and you have both the governance as well as the legal systems that protect the rights of the financiers and investors, either private equity or the bank investors, and sufficiently strong and experienced sponsors. It's very difficult for some of these projects to go ahead. So when we look at some of these situations, it comes back to what I had mentioned earlier, the political situation and governance standards. It looks at the fact that finance has to be available. It looks at the fact that the demand was always there. But in terms of having a consistent rules of the game, you cannot have a situation whereby you are working on a transaction and midway, the government believes that the tax take needs to double. As we have seen in a number of markets where you've got resource nationalism that has come up, because typically what happens is this. Resources get found. Some do good NGOs go and advise the government. They hike the tax rate so high, or the concession rates are so hostile, that it just makes no sense for any investor to do anything. We've got very sad examples of that in a number of countries in East Africa where oil has been discovered and in commercial quantities over the last 6 years. And nothing has happened, and nothing would happen until you come to terms with the fact that there must be a balance in terms of the yield for the investors, the local stakeholders, and to make sure that the financiers are also well paid, which is always something that is very dear to my heart. So, what? So, well, from the clapping, it does give me a feeling that quite a number of you guys seem to be looking at financial services as a future career. So you're welcome to that. And irrespective of the demonization of financial systems in Europe and in the US, I can tell you that finance in Africa is still considered to be a very respectable occupation, and it's something that you will be very proud of, whether you're working with Standard Chartered Bank, which is the leading institution in this field in Africa, or some of our friends. Now, when we look at this, you look at, say, fine, what is required to actually enable this? It's very much about identifying the critical enablers across the board to make this work, and to have a conscious shift to a hybrid financing model that includes a combination of all the relevant parties, which includes government, the donors, in order to be able to support the government's ability to meet some of its obligations. And more importantly, and this is very important, it is so important that government gets well advised. So if there's any work or any contribution that donors should do, is to provide the right legal advice or the right level of financial or corporate advice for government, so that when they negotiate contracts, they are negotiating with their eyes wide open, and such that contracts are fair and balanced to all parties, such that they are not revisited. We need the multilateral agencies, our friends in IFC, the private sector finance institutions, offshore and onshore like Standard Chartered, and as well as the local banks. And more importantly, we need consumers to appreciate fundamentally that it is not possible to actually get good value without paying for it. So tariffs will go up, and you will not be able to avoid paying for electricity, water, and your waste disposal would be something that you would have to write a check for. And that brings a very clear awareness, a sense of shared responsibility, and what I've heard spoken about before, I think it's probably Maya Angelou, that it takes a village to raise a child. You should look at infrastructure and resource development in Africa as a young child, a baby that needs to be nurtured properly, and stakeholders need to support the growth of this child Otherwise, it would not develop at the right pace, or it will probably have stunted growth. So the enablers in terms of political stability on the government side, creating a legal field, open playing field that is level to all parties, having transparency and standardization of concession agreements, having the financial resources to pay their own way, and that's great because we are seeing the bonds that are being raised are now being channeled into equity on this project, having the right private sector enablers, having the financial institutions and markets that are incentivized to make this work. And when you look at all this, what will this happen? How do we measure success? And this is something that a lot of my colleagues always, they know that I tend to ask a lot. By the time people ask me to do things, I tend to say, okay, hold on. We're going on this journey. At the end of this, how do we actually understand that we are where we are meant to be? I think it comes back to a much more sustained pace. The way I would like to characterize the last 10 years of development in Africa and the pace whereby most African countries are in the 7% club is to look at it as the first inning for those of you that play cricket, and that for us to create an environment that creates the second inning. And that will be a sustained and a beneficial environment in terms of growth, in terms of engagement, in terms of infrastructure facilities that are of the right quality, that will be able to attract the best talent from everywhere in the world, whereby we will see no difference in going to live in Senegal or Ghana as in living in Philly or most other places in the world, and being able to actually have facilities that are comparable and costs that are comparable to what you have. At the moment, you're probably aware that the cost of manufacturing in China is gone up significantly. So the loss of China's cost advantage means that Africa's share of labor-intensive manufacturing means that China's share of labor-intensive manufacturing is falling. And over the next decade, this will shift to other low-wage areas. What does this mean for us? It means the fact that more people will be in the wage and hopefully the tax-paying bracket in Africa. I'm always very happy to infect other people with something that gives all of us in this room a lot of delight in terms of paying 50% tax to our Majesty's government or the US government. So, because if people don't earn a living, you can't expect them to pay tax. So the more taxes, the more people earn, the more taxes they pay, the more governments get accountable, and the more they challenge government for delivering resources. So we see a risk of complacency. We think that the current commodity and resource boom could erode competitiveness in other sectors. So one thing I would say very much is that it's important that one is mindful and that countries and sovereigns avoid a risk of currency appreciation significantly. And what I would just really say is this is a major risk of complacency by African leaders, thinking that by benefiting from the wind behind their backs in terms of higher growth, feel less need to pursue bold or politically risky reforms that could further modernize their economies. And what all of us can do is to continue to support African governments and Africa stakeholders using our networks, exposing them to first world and emerging market development such that they will feel no need to drop this momentum we have in terms of reform and progress. So, distinguished ladies and gentlemen, I know I'm standing behind you, between you and your coffees, although I'm not sure these guys actually care. I think they're serving you all the same. So I would repeat that it takes all stakeholders to support the growth of infrastructure development, consumer demand in Africa. And I would invite you to join us at Standard Chartered Bank and other well-meaning institutions on this journey to invest and contribute your talent to the development of Africa. And of course, enjoy the professional fulfillment and super returns on your investment as a consequence of the courage that you would have exercised in taking a stake in the most exciting market in the world. Thank you.